It was a Tuesday afternoon. The seller slid a manila folder across the kitchen table. Inside, a mortgage at 4.1%, a tax bill she couldn't pay, and a note that said, "I just need it gone." Dan had $5,300 in his pocket. 30 minutes later, he walked out with the deed to her house. None of his money went to her, no bank approved him, and no new loan got created. Just one transaction the lender knows nothing about, a transaction that operators have been running for 40 years. It's called Subject to. And in 2026, it's the closest thing to a no-money down house you can legally do. We'll get to how Dan did it. But first, the one paper that decides whether you walk away with a house or a lawsuit. Here's what we're covering. Promise 1 is the exact paperwork stack Dan used, 7 documents in the order they get signed. Promise 2 is the truth about the due on sale clause. What actually triggers it, what doesn't, and the one thing banks are doing in 2026 that nobody's talking about. Promise 3 is the #1 reason these deals fall apart, and it has nothing to do with the bank. Quick note before we dig in. This is educational, not legal or financial advice. Real estate laws vary by state, and subject to deals carry real legal exposure. Talk to a local real estate attorney before you do one. I mean that. Now, let's get into it. So what is subject to actually? Plain English. You take title to a house, but the seller's existing mortgage stays in the seller's name. You don't pay it off, and you don't qualify for a new one. The lender never consents and typically doesn't even know. You walk away with the deed, the seller still shows on the mortgage note, and you make the payments directly to their loan servicer. You own the house. The bank thinks the original borrower still does. That's the entire mechanic in one sentence. Title transfers. The mortgage does not. People confuse this with 2 other things, so let's separate them. A formal loan assumption is different. In an assumption, the lender approves you, runs your credit, and legally moves the note to your name. FHA and VA loans allow this, but conventional loans almost never do. A wrap mortgage is also different. In a wrap, the seller creates a new note at a higher rate that wraps around the underlying mortgage. You pay the seller pays the underlying lender, and the seller keeps the spread. Subject to is none of that. It's just a deed recording, and nothing else changes on paper. So why would any seller agree to this in 2026? 4 reasons. Reason 1, they're behind on payments. Foreclosure starts rose 20% year over year in the first quarter of 2026, and 82,631 homes entered the foreclosure pipeline in a single quarter, according to ATTOM data. That's a growing pool of sellers who want out before foreclosure goes on their credit. Reason 2, divorce, death, or an abrupt life change. They need to vacate fast and they don't want or need cash at closing. Reason 3, equity-light sellers who bought in 2021 or 2022 at the peak. They owe near market value, and if they list traditionally, the realtor commission eats whatever's left. They'd net negative. Subject to lets them exit without writing a check at closing. Reason 4, inherited property where the heir doesn't want to manage it. Selling subject to is the path of least resistance. The pitch to a seller is never about saving them money on their interest rate. That's not what they care about. The pitch is, I'll take this liability off your plate without you needing cash to close. That's it. Memorize that line. Now, before we go deeper, here's the part that scares most beginners away, and it shouldn't. Promise 1. The paperwork stack, 7 documents, in the order they get signed. Document 1 is the warranty deed, or in some states, the quitclaim deed. This is the instrument that transfers title from the seller to you, and it gets recorded at the county. The moment that's recorded, you're the owner. Document 2 is the purchase and sale agreement. This is your contract, and it explicitly states the transaction is subject to the existing mortgage. That language matters. It's the legal anchor. Document 3 is the authorization to release loan information. The seller signs this, and it lets you talk directly to the loan servicer. Without it, you're flying blind. Some servicers won't speak to you at all unless this is on file. Document 4 is the seller's disclosure and acknowledgement. The seller signs a written confirmation that they understand 3 things: that the mortgage stays in their name, that their credit is at risk if you default, and that the due on sale clause exists. This document is your liability firewall. Without it, the seller can later claim they were misled. With it, you have a paper trail. Document 5 is the payment authorization and ACH setup. This documents how and where payments go. Most operators set up a dedicated bank account that auto-pays the servicer the same day every month. Never miss a payment. Document 6 is the limited power of attorney. Optional in some states, but operationally critical in all of them. It lets you handle insurance, lender correspondence, and any payoff later, especially when the seller moves out of state. Get one drafted. Document 7 is the land trust assignment. This is the optional one, but in 2026 it might be the one that saves your deal. We'll come back to it. Total cost to close, no down payment. Closing attorney drafts your stack for $800 to $1,500. Title search runs $150 to $400. Recording fees $25 to $150. Optional title insurance $300 to $800. And land trust setup $300 to $700 if you use one. Estimated total $1,500 to $3,500. No down payment to seller, and no lender fees. That fits inside our $5,300 budget with room to spare. If the loan is in arrears and you're catching it up as part of the deal, add reinstatement costs of $2,000 to $8,000 depending on how far behind. That pushes the total to $4,000 to $8,000. Tighter, but still doable. Time from signed contract to keys in hand? 2 to 4 weeks, with no appraisal, no lender approval, no underwriting, and no inspection contingency unless you want one. The deed gets signed, notarized, and recorded. Done. Okay. Deep breath. We're about to talk about the clause that every real estate guru on YouTube either ignores or lies about, the due on sale clause. And in 2026, the rules just changed. Here's what the clause actually says. The Garn-Saint-Germain Act of 1982, codified at Title 12 of the United States Code, Section 1701J3, gives lenders the right to call the loan due if the property is sold or transferred without their written consent. Federal preemption. The clause in your standard mortgage reads, the lender may, at its option, declare the entire loan immediately due and payable. 3 words there matter most. At its option. This is a right, not a mandate, and lenders are not required to call it. What actually triggers it? Recording a deed in your personal name at the county is the biggest trigger because it leaves a public trail. Transferring title into an LLC after acquisition is a common mistake that flags servicers. Refinancing the property triggers it. Listing the property on the multiple listing service triggers it, and canceling the seller's homeowner insurance policy triggers it. That last one. We'll come back to. What does not trigger it? The Garn-Saint-Germain Act lists specific exempt transfers. Transfer to a relative on the borrower's death is exempt. Transfer to a spouse in a divorce is exempt. And transfer into an inter vivos trust, where the borrower remains a beneficiary, is also exempt. That last exemption is the land trust play. The seller deeds the property into a land trust, with the seller staying as trustee and beneficiary at first. The recorded deed shows the trust name, not a buyer name. Then, in a separate, unrecorded assignment, the buyer purchases the beneficial interest and steps in as trustee. The lender sees no name change. The trust stayed the same. That's how operators in 2026 are reducing detection risk. Talk to your attorney about whether your state recognizes this structure. Most do, some do not. Here's the 2026 wrinkle. Banks are now using software to scan title records for transfers, especially on Fannie Mae and Freddie Mac-backed loans. Their automated underwriting systems flag address to deed mismatches, and conventional loans backed by those agencies carry meaningfully higher detection risk this year than they did 3 years ago. Portfolio loans held by smaller banks and credit unions usually do not get this kind of scanning. So before you take over a mortgage, get the seller's authorization to pull the loan info, find out who backs the loan, and price the risk accordingly. Second 2026 wrinkle. There's a new financial crimes enforcement network reporting requirement that took effect this March, and it applies to real estate transactions involving an LLC or a trust. Penalties for non-compliance can reach $278,000 per transaction. If you structure your subject to through an LLC or land trust, your closing attorney needs to file the FinCEN form. This is not optional anymore. Build it into your closing checklist. So when does a lender actually call the loan? Almost never, as long as the loan stays current. Banks make money when payments come in, and they lose money when they have to foreclose. They aren't sitting around looking for excuses to accelerate performing loans. The Dios gets called when something else goes wrong first. Usually, missed payments, which brings us to the failure mode. Picture this. It's month 14 of your subject to deal, everything is fine, and the mortgage is current. Then one Saturday morning, you get a letter from the bank, and it doesn't say what you think it says. It says your homeowner insurance has lapsed. The bank is force-placing coverage at 4 times the premium and charging it to the escrow account. The escrow is now negative $700. They're sending a deficiency notice to the seller, whose name is still on the mortgage, and who you haven't talked to in 8 months. This is the silent killer of subject to deals. Insurance and escrow handoff. Here's the failure chain. The original homeowner policy was in the seller's name. After closing, the seller moves out of state. 2 years later, the seller gets frustrated by mail forwarding or just stops paying attention and cancels the policy. The insurer notifies the lender force places coverage at 2 to 5 times the premium, and escrow goes short. The lender sends notices to the seller panics or doesn't respond. The lender pulls a title search and discovers the deed transfer. Now we have a due on sale problem. Not because the bank was scanning, but because the insurance lapsed. How do you prevent it? 3 steps. Before closing, add yourself as additional insured on the seller's existing policy and get written confirmation from the insurer. Or work with a specialty carrier who writes non-owner occupant policies that acknowledge the subject to structure. Set up direct lender access through that authorization to release form so you receive copies of every escrow notice. And maintain a cash reserve equal to 3 months of total mortgage payment, principal, interest, taxes, and insurance, $2,000 to $4,500 sitting in a separate account, untouchable. That buffer absorbs escrow deficiencies before they cascade. Now, let's run the numbers on Dan's actual deal in that Pennsylvania river town. The existing mortgage balance was $180,000 at 4.1%. The house value at closing was $240,000. And the equity captured at acquisition was $60,000, with no money to the seller. That's real equity. Unrealized, but real. Monthly principal, interest, taxes, and insurance on the takeover loan came to $1,200. Market rent in that neighborhood was $1,650, and monthly cash flow landed at $450 after a 5% vacancy reserve. This is the loan takeover method. 3 components stacked. 1. You take the deed without taking the loan. 2. The seller's existing rate stays locked in below current market. 3. You preserve your cash to do another deal in 12 months instead of locking it up in a down payment. Year 1 cash flow comes in at $5,400. Year 2, with a 3% rent bump, hits $6,000. Year 3 reaches $6,600. Year 4 climbs to $7,200, and Year 5 lands at $7,800. 5-year cumulative cash flow on a deal where you put no money to the seller. $33,000. Plus that $60,000 of captured equity, plus principal paydown on the existing loan, plus tax depreciation. That's the cumulative picture. 5 subject to friendly states to look at. First are Florida, Georgia, Missouri, Ohio, and Indiana. Why those? Non-judicial foreclosure, investor-friendly courts, strong title company infrastructure, and lower deed transfer taxes. 3 states where it gets harder. Texas requires the seller to give you written disclosure 7 days before signing any contract for a property with an existing mortgage under Texas Property Code Section 5.016. Violated. And the contract can be voided. North Carolina's Real Estate Commission issues active consumer warnings about Subject to, and their February 2026 bulletin tells agents to flag these transactions. Regulatory scrutiny is real there. California has high deed transfer taxes and consumer protection courts that scrutinize trust structures more aggressively. Doable, just slower and more expensive. So what's your actual next step? You don't need to find a deal tomorrow. You need to do 4 things this week. 1. Pull the Garn-Saint-Germain Act text online and read Section 1701J3. 20 minutes of reading you'll feel for the rest of your career. 2. Find a local real estate attorney who has closed at least 3 subject to deals. Not a residential closer, but an investor attorney. Get a 30-minute consult and ask them how their county records the deed and which insurance carriers in your state write non-owner occupant policies. 3. Build your 7-document checklist, print it, put it in a binder, and carry the binder to seller meetings. 4. Set aside that 3-month reserve of $2,000 to $4,500. Untouchable. Then look for sellers who match the 4 motivation profiles: pre-foreclosure, divorce or estate, equity-light recent buyers, and inherited properties. Pull a foreclosure list from your county and pull a probate list, both of which are public records. The sellers are reachable through normal mail and respectful conversation. Never harass anyone. Never pretend to be anything you're not. The pitch is simple. I can take this liability off your plate without you needing cash to close. That's it. One last thing. Subject to is not a magic trick, it's a tool, a real one. Used correctly with the right paperwork, the right reserve, and the right insurance handoff, it lets a person with $5,300 in their pocket take title to a house that would otherwise require a $50,000 down payment. The lender stays informed enough through performing payments, the seller gets out clean, and you get the deed and the cash flow. Everybody wins. The math works, the law allows it, and the only question is whether you're going to do the homework to do it right. That's Subject to in 2026. The loan takeover method. Now, go pull that statute.